scores being better. Lenders, banks, landlords, and even employers use this score to decide whether they can trust you with credit, housing, or financial responsibilities. A good score can mean lower interest rates, bigger loan approvals, and better financial opportunities. A poor score can mean getting denied or paying more for everything. Now, your score is calculated based on several factors. The biggest one is your payment history, which accounts for 35% of your score. That means whether or not you pay your bills on time. Next is your credit utilization ratio, which is 30% of your score. That measures how much of your available credit you're using. The lower your utilization, the better. Then comes the length of your credit history, which is 15%. The longer you've had accounts open and in good standing, the more points you score. After that, 10% comes from your credit mix. How many different types of credit you have, like credit cards, auto loans, or student loans. And finally, 10% is based on recent credit inquiries, especially hard inquiries from applications. Now here's where the credit card comes in. A single credit card can help with every one of these categories. By opening a credit card and using it responsibly, you create a payment history. Every on-time payment you make is a positive signal to credit bureaus. By keeping your balance low, you show responsible usage and lower your utilization ratio. As time goes on, your account's age helps your credit history grow. If you have only a credit card, it still counts as part of your credit mix. And as long as you don't apply for too many cards at once, you avoid negative impact from inquiries. So how do you start? First, if you don't already have a credit card, apply for one designed for beginners. This could be a secured card where you deposit your own money as a safety net, or a student card if you're in school. Some banks also offer entry-level cards with no annual fee and limited rewards, perfect for building credit. Once you're a